E&J Capital. Today's video will be about Contango and backwardation. What does it mean? Team No Haircut. USO, United States Oil Fund, has been in the news a lot recently. In our previous video, we talked about reverse stock splits, how they issued 8-to-1. You had 8 shares of USO. You would now have 1 share. The values didn't change, but that 1 share, the price is higher due to, the 8 turns into 1. It just supersizes that bad boy. The value of those shares had to increase because, the market cap, market capitalization is share price times number of shares outstanding. If you cut the number of shares outstanding, but the market cap stays the same, then the price of those shares would have to go up as well. But we're not talking about reverse stock splits anymore. We're talking about Contango. And Contango fits well with USO. Side note, not all ETFs move the same way. Before you buy an ETF, understand how it makes its money. And we're going to get into that with USO. So first, you're going to need to know what futures contracts are. Futures contracts is similar to an option contract, where it's an agreement to buy a certain commodity in the future at a certain date at a certain price. Let's say you worked at an oil rig and you need 100 barrels of oil. You're comfortable paying this set amount because you don't know where oil will be in the future. So you say, okay, I'll set my strike at this price because that's where I'm comfortable buying. And maybe you'll make a profit. Maybe you'll lose money if the price isn't close to where the actual price of oil is. You live and you learn. So anyway, back to USO. The way USO makes money is it has a lot of exposure to WTI futures contracts, crude oil futures contracts. What they do, let's say, for example, they'll buy this month 1,000 contracts, and they roll these contracts month over month or every few months, but their strategy is they roll contracts forward. So the thing with futures, similar to options again, is they have expiration dates. 3 things you could do with these futures contracts. Number 1, you sell the contract before it expires, either for a profit or for a loss. Number 2, you exercise those contracts, meaning if the contract is for owning 100 barrels of crude oil, that means if you exercise them, you now own the 100 barrels of crude oil. You pay for those and you store them. You get the physical, you get the barrels on the crates. Those are yours. Or number 3, you roll them. You roll your contract forward, meaning you delay that payment. You delay that expiration date. And you say, okay, I don't want to buy this month. I don't know what I want to do, so let me just roll it again to the future. And that's what USO does. And when you roll it, you need to close it before expiration and then buy the same amount the next month over. So if you bought 100 in May, you close those out and then you rebuy 100 for the next month. Now, Contango. Let's draw it. This is my chart. WTI futures contracts, price of oil on the y-axis, futures on the x-axis. If you wanted to buy oil right now, or any other commodity right now, you're paying the spot price. The spot price is the right now value. Futures contracts pay for a future date because the supplier holds these commodities for you until that date arrives. Say the spot price of oil is right here. In a contango market, the spot price is below the futures price. In the futures, the farther out in time, the more expensive the futures contract will be, because they believe that the price of oil will go back up, people will start flying again, people will start driving again, the demand will come back. Right now there's no demand. They're sitting on barrels and barrels of oil and nobody wants to buy it. So there's lack of demand and oil is in contango right now. Further, futures contracts are higher than the spot price today and the expected spot price of the future. If forwardation, aka contango, means upward slope, where the futures price is higher than the spot price, what do you think backwardation means? Go ahead. It has a downward slope. I might not know what backwardation, how to spell it. Meaning, spot price is above the futures price. And that's when, the demand is coming in hot. Everybody's flying. People want oil just like that. And that could be to any commodity. It could be gold. If you're a rapper and you need gold right now, you'll pay that premium, you'll pay extra for your gold. You need it on set. You need to look good. Anyway, talk about USO. The thing about USO, like I said, they roll futures contracts. So let's say they they bought 1,000 contracts in January. So they bought 1,000 contracts. Now they roll, they close, and then rebuy future date, rebuy future, and that's their strategy. Now what's the problem with that? If the market is a contango and the slope is going upward, meaning they'll have to pay more each time they close it. Each time they roll those futures forward, they're gonna have to pay higher premiums each month. As it goes up, the premiums gets higher, they pay more, and they end up with less contracts at the end. Because if they started with 1,000 contracts here, the next month, maybe they can only buy 900. The next month over, maybe they can only buy 700. You see how they lose contracts? Before you buy an ETF, make sure you know where their money comes from and how much exposure they have in futures contracts. Because USO is all futures contracts. And that's a big part of the reason why it's been going down. Contango, backwardation, spot price, right now price. Like and subscribe.